group insolvency right now, so just wait for some time. Then they said there are a lot of stakeholder grievances coming, where lenders are common and they see entities have one commercial. So it becomes very important that in such cases, some framework is there which gives certainty. IBC is all about certainty, certainty of time, certainty of having a judicial body. The blessings of NCLT is always taken. So here also we need some kind of framework which gives a certainty that if you are a group entity, then also resolution is possible, and this is the mechanism rather than fighting it out in the court and having lenders fight amongst each other for their interest. A framework is very much needed to bring in clarity. Now, the third thing which the working group saw is that there might be asymmetry of information between creditors and promoters and other members of the group. Basically, what they are saying is, see, if there is one CRP in holding company, one CRP in a subsidiary company, one somewhere else, everybody will have a different RP, different COC, and there might be non-consistent information available with all the three. One will not want to share with the other will not want to share with the another one. So there will be asymmetry of information. When you have a group CRP, that asymmetry will come down to a large extent. So these are like the positive things the working group stated which should be there to bring in group insolvency. Working group also noted some, like one of the main cases was Videocon case. So they referred to the Venugopal Doot, this is State Bank of India case. So here, multiple companies of Videocon group were put through insolvency resolution process. Parties sought that all matters pertaining to insolvency resolution of different Videocon entities be dealt with same adjudicating authority, because they were all parked with different benches and used to create a lot of confusion. Also, there are always apprehension of conflicting judgments. One bench might take one stand, different bench might take a different stand in a related case, right? So to avoid all that, this was allowed. So the CRP as one in respect of all these companies, principal bench of NCLT ordered that all the matters regarding insolvency resolution process of these different companies be dealt with by the same bench of NCLT for purpose of avoiding conflicting orders and facilitating hearing of these matters. This came as order to allow for such consolidation. Again, in Videocon only, NCLT ordered that the assets and liabilities of 13 Videocon companies should be substantively consolidated due to common control, common directors, common assets, common liabilities, interdependence, interlacing of finance, coexistence for survival, pooling of resources, intertwined accounts, interloping of debts, singleness of economic of unit, common financial debtor, and common group of corporate debtor. These actually are the factors which even the working group then dwelled on to, which became kind of basis for suggesting a consolidation framework or a group CRP framework. So this was really a landmark judgment, and this judgment really made a difference in the evolvement of group CRP process. So common control can be, if I can choose the board of director in your company, and your board is accustomed to act as per my wish, right? So I can say there is some control I exercise, and if I exercise same kind of control somewhere else, I can say I have common control over those two entities. Common directors, common assets, obviously same assets are giving value to both the entities. Common liabilities, we owe to the same lenders. There might be cases that you took a loan, I gave a corporate guarantee for your loan, so the same loan is a liability for both of us, right? You have on your books as a loan, I have on as a contingent liability as a corporate guarantee. Interdependence, we are interdependent financially and operationally. Interlacing of finance, right? The finance sanction terms must be so that there is a flow through of finance or sanction from the banks to subsidiaries, or there can be intercorporate deposits as well. Temporary funding, loss funding, bridge funding, all these things which are done between related parties. Coexistence for survival, one cannot exist without the other. Pooling of resources like employees, directors, common share services. Intertwined accounts, the ledger entries, you keep setting off ledger balance, receivable, payable. Interloping of debts, again the same liability concept. Singleness of economics of unit, again one cannot function with another, one cannot earn or make a viable business model without the help of another. Common financial creditors, same lenders in both the companies, and common group of corporate debtors. Maybe they fall within the same structure. These are the aspects which Videocon Industries case gave us, which was detailed, and it gave us a foundation of laying this group insolvency framework. Then you had one case of Sachet Infrastructure Edelweiss. Here, NCLAR said that group insolvency proceedings were required to be initiated against 5 companies that had been working as a joint consortium to develop a residential plotted colony. To enable successful development of this colony, NCLAT ordered that simultaneous CRP should continue against them under the guidance of same resolution professional who should run the process so they are completed in one go by initiating a consolidated resolution plan for total development. So they use the word consolidated resolution plan. So they mean to say one single resolution plan can come in. Then you had Honorable Apex Court judgment in Chitra Sharma versus Union of India. So here insolvency proceedings were initiated against JP Infratech, and home buyers had entered into contract with both JP and its holding company Jaiprakash Associate. And the Honorable Apex Court ordered that parent company which was not subject, they ordered Jaiprakash to deposit 2,000 crores in the court, right? Although Jaiprakash was not in insolvency, they ordered them to submit deposit 2,000 crores in the court because there was common control, and they know that money has to come from the common control ultimate holding only, and this subsidiary will not have any money to pay for. Then you have Bikram Chatterjee versus Union of India. Again, it's a real estate case. So home buyers in projects developed by different companies of Amrapali filed a writ petition before Honorable Supreme Court to protect their interests in wake of insolvency of companies. Supreme Court in these proceedings dealt with the group as whole. Given the nature of transaction between group companies, the court also ordered that properties of all 40 group companies be attached and bank accounts of all companies and directors be frozen. So although you don't see a substantial CRP consolidation or procedural CRP consolidation, but you see that assets are getting attached, banks accounts are getting attached of the entire group entities, because the courts are acknowledging the fact that these work together, these are one single economic unit, and without attaching all the assets of related units, you really can't get any revival prospects. Then apart from what is given in the working group committee report, there are also some cases which we'll study in detail also. I'll show you the judgments also. There was one case of Lavasa, right? Everybody must be knowing about this. Here NCLT had consolidated Lavasa group insolvencies to avoid potential losses likely to be caused by fractured insolvencies. That the term they used, right? While noting that the insolvency of subsidiaries largely depend on the outcome of parents' insolvency. So here NCLT said that the subsidiaries resolution depends on the parents resolution. So better you consolidate all of them. Then you had ILFS case. So ILFS case showed a lot of systematic deficiencies in our banking, and a lot of people were affected also by ILFS. But this was a very large insolvency case. There were 348 entities in this. Honorable NCLAT had observed that the law has developed where group insolvency is permissible. In fact, when ILFS judgment first came, they did not do that classification. Everybody must be remembering that the classification of the debtor's ability to reservice its debts was done. So basically, they termed as green, amber, and red. So green companies were the ones who could service their debts. Amber, which could partially service their debt, and red, which could not service. So consolidation of CARPs of entities was done based on these classifications. So one lot of green entities, one amber, and one red entities. So when it came for the first time, when the judgment came, they did not do the classification. But second time, understanding the complexity of it, and the revival prospects is hit, because if you are mixing red with green, maybe the persons who will come for green also will not come, because you're again making the deal better for him, right? So the second time the judgment came, they really clarified on the judgment on the classifications. Then section 60 subsection 2 and section 60 subsection 3 of the IBC. So they basically provide that the insolvency proceedings of a company and its guarantor would be dealt by same adjudicating authority. So we are basically seeing the provisions which kind of somewhere reference that how things can be made easier. So these sections say that cooperator and guarantor, insolvency of both of them should be handled by the same adjudicating authority to avoid any confusions. And you have section 18F, the section 36 of the code. These basically give the power over assets, right? Resolution professional or liquidator has certain powers vested in him because he's managing the affairs of the company. So that asset includes the investment in shares of subsidiary companies also, right? So the resolution professional liquidator can very well control those investments. They can very well get information from the subsidiary companies because they're holding shares of the subsidiary companies. So these also hint that you can have a control over the group through these shareholdings. Then some provisions in the code target perverse behavior. When we say target perverse behavior, we are simply saying that related party transactions are looked a bit differently. I think somebody's on not on mute. Request them to put on mute. So when we say targeting perverse behavior, basically, if you look at section 29A, right? So if you are a related party defaulting promoter barred by SEBI, insider trading, or willful defaulter having an NPA, so many bars are given to say that you are not eligible to give a resolution plan because it's because of you the company is under CR. So there's a bar on resolution applicants to give plan. Also, if you see transaction review, when you do a preferential transaction review, which people generally call as PUFE or avoidance transaction, the time period for related parties is 2 years vis-a-vis the time period for others, which is 1 year, right? So, and also if you have a related party transaction, it has to be approved by COC. RP cannot do it independently. So there are checks and balances given in the provisions of the code to tackle the perverse behavior of related parties, or nobody should be able to misuse such group structures. Now, some advantages of group insolvency: it promotes information symmetry because everybody comes in the group and they then tend to share the information amongst each other. There will be reduction in cost of insolvency proceedings since lot of duplication happens when you have different CRPs. You are doing different public announcement, different RP fees is there, different COC meetings are happening. Entire process is running parallel to each other, right? And when you are able to collate that, put it in one shot in one group, you are able to at least reduce the duplication of efforts and also duplication of cost. Maximization of value, as we discussed, it's always the sum of two entities will always be more than the value of one individual entity, right? So there will be maximization of value if there are interlinkages that are so strong, operational, financial, that one cannot function without the another. There will be strong maximization of value when we are doing a consolidated CRP or a group CRP. Reduction in cost of capital, right? So just in case I'm having similar lenders, but different CRPs are running, a lender might feel it's okay for him to infuse interim finance in one entity but not in another entity, right? But if you have group insolvency, group of consortium lenders, the cost of capital comes down because they know the group well, they have lent the money before, right? And everybody in that group COC is able to work together to bring down the cost of capital, to try to make it viable somehow. If they are not working in sync with each other, it results in a lot of outflow to even third parties. Sometimes you raise interim finance from third parties, you end up paying 21-25% interest, right? So that kind of cost of capital can be reduced. Also, there is increased certainty for stakeholders and saves judicial time. All the stakeholders are at least aware that this is a group CRP running. I have to subject myself to only this process. Resolution applicants know that I have to give one resolution plan and it will be taken to the group COC. They will approve, then NCLT will approve. NCLT is then helped by not getting the burden of dealing with multiple CRP and multiple litigation arising out of multiple CRPs. So it definitely looks at saving a lot of time. It looks at giving a lot of clarity. Again, just a illustration very similar to what we had before, right? So different entities doing different operations, but they have strong interlinkages. So when you have strong interlinkages and you resolve to have a group CRP, you have joint COC meetings, you have one single RP, one resolution plan process, it saves time for NCLT and stakeholders both. Now, some disadvantages of group insolvency. So the working group is saying that there can be cases where the subsidiary CRP company might be running well without the holding company's help, right? There might be cases that they don't want to consolidate, they don't want to join the other CRP, and they are doing well by themselves, and they don't want to get into this process, right? So if they are forced to do it, then there are always chances that they start non-cooperating, or they tend to create a situation where they raise the cost of capital so much, because when you have to substantially consolidate CRPs, there will be a consolidation of claims also, right? If a holding company creditors have maybe say 30,000 crores of debt, and the subsidiary creditors only have like 800 crores of debt, if you are going to consolidate, in the consolidated claim amount, the subsidiaries portion will be very minimal, and they will feel that they are losing all their say in the COC. At least here, they have a strong say in the COC, right? But there, when they consolidate, their say will be very minimal. So there might be situations created where they make it very difficult for consolidation to happen, and they don't want the consolidation basically. Say so they start infusing interim finance at a very high rate of interest, or they make it very difficult to have the consolidation happen. Potential for expenses for the framework too. So basically, when you have to do a group CRP, working group says you will have to probably appoint a consultant or professional expert who can drive this down, and there will be a lot of ancillary costs which will be incurred when you do a group insolvency. So group COC means you might have 100, 120 lenders sitting in a room discussing, and you have to run, although process might merge, but you still have to conduct the process on a large scale. So there might be some ancillary cost on that. Potential for unfair capture of value by some stakeholders. So here they are saying that there can be chances if you are doing a group CRP or a consolidation of CRP, it might happen that the large lenders somewhere dominate and dilute the other lenders' proposition in the COC, right? So that is very much possible, and there will be unfair capture of value by such stakeholders. If that is done, then the small stakeholders will not get anything, and they will be at a loss. So ILFS, again, I said, right, that the first judgment did not talk about the categorization, but a consequent judgment made it into green, red, and amber. So 11th February 2019, NCLAT lifted moratorium on offshore companies and 22 other entities falling under the group which could service debt obligations. So there were companies which could service their debt obligation. So NCLAT lifted moratorium on those entities. 70 entities were also classified into group of green, amber, and red on the basis of ability to discharge their debt obligation. 22 entities which were classified as green were those companies which could service, while 10 under amber could partly meet their obligation, and 38 red entities were those which could not meet any payment obligation. The inability of green entities to trade during moratorium would have imposed cost on stakeholders of these entities. So, if you push everything into insolvency, although some entities are able to work and they are able to serve their debt, and you push them also into insolvency and they somehow then stop trading, it affects the entire group's financials. This could have been avoided if there was a formal framework for resolution of companies in a group. Then, based on all these things, working group said there is a need for comprehensive regulatory framework to facilitate insolvency resolution and liquidation of companies in a group. They also recommended that the framework should address special issues arising in insolvency of companies in a group. However, the framework should be tailored so as to maximize advantages and alleviate the concerns discussed above. So this was basically the working group report. Summary is they gave two phases how it should be done. Phase one, they suggested procedural consolidation. Phase two, they said as we develop, we should go for substantial consolidation. And they also said we should have rules for perverse behavior of companies in a corporate group, so that group structure is not misutilized by promoters or entities having common control. So when we talk about phase one, they said there are some elements which can be done, like joint application process for insolvency of multiple companies. So one application for triggering insolvency, communication, cooperation, and information sharing between different insolvency professional, NCLT, COC, and IBC. So basically, a stakeholder communication mechanism should be there where all these different stakeholders can coordinate and communicate. Single NCLT to administer insolvency proceedings in such cases. single insolvency professional for companies in a corporate group, creation of group credit task committee, enabling of group coordination proceedings, extension of overall time frame for conclusion of CRP of group entities to 420 days, right? And then in phase two, they said we should try for substantial conservation of assets and liabilities and make it a single economic unit. Then there is also a summary of recommendation of working group. Probably we can go to that later if you have time. After this, we'll definitely go to the summary. But this is the crux of the working group report. Then, but the report had some clarity issues, right? So these issues are getting tackled even now as we speak. So the definition of term corporate group. So working group says it includes holding subsidiary associate. Okay, what about joint ventures? What about, you can't vaguely define group, right? Group can also mean any entity having a significant control over me or is able to exercise significant influence over my decisions. That should also form part of group. This is given in your CBRC report, right? Then inherent ambiguity between jurisdictional issue. One company might be in Ahmedabad, one might be in Delhi. So how will that jurisdiction issue be sorted? So these are like lack of clarity when the working group report came. Applicability of cross-border insolvency provisions. This exists. This lack of clarity exists till date. We are not uh, having any framework on cross-border insolvency. Non-settlement of application of principle of extension of liability. So if I am a group entity, is my liability affecting the other group entity as well? Is there an extension of liability? So that principle has to be settled. If we say every entity has a different legal identity, and how can I put my liability on different entity? Right? Lack of consideration of issues relating to provisions for dealing with multiple tax jurisdictions, concept of group moratorium, procedure to move out from group insolvency in case of settlement. So suppose a settlement happens, group insolvency is running and the settlement happens between creditors and debtors. What happens? How does the company come out? If there is settlement with one component of that group, then what happens? Feasibility of insolvency proceedings having cross investment and backward and forward linkages with other group entities without consolidation. Can there be a revival of such entities without consolidation? Alignment of management of multiple group companies by single RP. So all these things are clarities which were left to be attended. Now coming on to some case laws. Okay. So we'll obviously have time. We'll go through the judgments also, some important paras, relevant paras also. The first one and the one which set out the ground for this framework is your SBI versus Videocon, 8th August 2019, NCLT Mumbai. So here the promoter had filed an appeal and then NCLT allowed consolidation of 13 entities of Videocon. NCLT, while allowing consolidation, relied upon precedents in UK and US because we do not have anything here. They relied on precedents of UK and US courts. Commonality of debt repayment obligation, management, asset, liability, interlacing of financial structure were cited as the grounds for its decision. Substantive consolidation of the group entities solely for the purpose of insolvency was called for. So, consolidation into single insolvency process, consolidation of assets, liabilities, elimination of intra-company debts, pooling of individual guarantees given by group companies, constitution of common COC, and appointment of common resolution provision with a common insolvency commencement date. This also is a problem which happens that different entities in a group have different insolvency commencement date, and then the timeline is different because of that, right? And yeah, when you have to do a consolidation, it has to then start at the basic ground. It has to start with the same date and have a same end date, and all the timelines should sync with each other. The bench laid down 14 parameters which are required to be verified based in approach of US bankruptcy codes. So we'll just go through the order right now. There are 14 aspects. So I'll just share that screen right now. If I'm going too fast, is there anything you want to ask in between also? Please feel free to ask. So this is the NCLT judgment video con, right? So just reading some highlighted text. NCLT says it is appropriate and suitable to give a ruling that at this occasion that there is no single yardstick or measurement on the basis of which a motion of consolidation can or cannot be approved. Right? So that it's a gray area. With humility, this bench herein below sets out a list of examples based upon reading the history of group insolvency so that the presence of them can lead to a decisive conclusion of triggering of consolidation of insolvency process. Undisputedly and also laid down by courts before ordering consolidation, a preliminary searching inquiry be ensured that whether consolidation yields benefit to stakeholder by offsetting the harm if not consolidated. Areas of inquisition and our findings of the case are, so they are telling that, these parameters, how they are getting fulfilled in the case. Common control. These companies, Videocon entities, are promoted by Dhoot family. Common directors, the family members of Mr. Dhoot are directors in all group companies. Common assets. There are many instances of interdependency between group companies and assets are common to such an extent that, for instance, one company has leased its land to another company to carry on manufacturing. Such is the interlinkage. Then common liabilities. The clause of VTL and RTL, right, that's the entities, have demonstrated that all guarantees thereof executed by one or more of the other corporate debtor are deemed to be one obligation of all the corporate debtors. Company, along with 12 other affiliates, are referred as obligors and individually referred as borrower. They have executed facility agreement with consortium of existing domestic rupee term lenders in the obligor co-obligor structure, wherein all obligors are pulled together. So there is common liability. Everybody is paying back the loan, right? Then interdependence. Some corporate debtors are engaged in manufacturing, assembling, and distribution of comprehensive range of consumer electronics. Also manufacturing set-top box, etc. This is stated to be India's largest economic electronic retail chain. The uniqueness stated to be that all marketed are under single license of Videocon trademark. Just give me one moment. I'm so sorry for that. So they say that there is a uniqueness in this business model, and all the products are marketed under one single trademark. Interlacing of finances, then they again say that, consortium of banks are lending to holding also, subsidiary also. So they are all same. The rupee term loan has been sanctioned by lenders for the purpose of refinancing of existing rupee debt of obligors, funding capital expenditure in relation to. So basically, it's a back-to-back arrangement, right? And restructuring of loan has been done for lending of the subsidiaries as well. So they are saying there's an interlacing of financing also. Pooling of resources. Facts and evidence have demonstrated that there was common pooling of human resources, licensing and funding. The directors are common using their contacts and relationship to run all the subsidiaries for which common office staff accountants are mobilized to manage affairs collectively. So this was the point we discussed on employees and directors. Then coming on coexistence for survival. An interlinked chain of business operation is also evident in this group case. Electronic gadgets are manufactured by a unit, however, distribution is controlled by another entity. Interdependence upon each other is a unique feature visible in the Videocon group. Then intricate link of subsidiaries. Consolidated accounts, pooling of resources, commingling of assets and business functions are examples of intricate link among subsidiaries. Intertwined accounts. The consolidated accounts of 15 months is one of the evidence to demonstrate that on demand by the lenders, all subsidiaries have prepared a common position of assets and liabilities. Thereafter, prepared consolidated accounts stated to be duly approved by a auditor. So they are even giving consolidated accounts to the lenders. Interlooping of debts, again, same thing like liability, right? Then you have common financial debtor. As per two agreements, the lenders are members of consortium banks, which is common for all. Then common group of corporate debtor. As per the two agreements, the debtors are combined together for the purpose of availing various loan facility, right? So these things were there based on which NCLT says that we have to consolidate these entities. Now coming back to the slides. Now we have a case of Sangvi Motors, right? And it's a June 2021 judgment. So basically here also it's a automobile related case. So here corporate data, your Sangvi Motors is the corporate data, and operational data has triggered a CRP here. So corporate data is a subsidiary of, there is a Dubai based entity called, again somebody's on unmute, I'll request them to keep on mute. So the corporate data runs the business in India, but it is subsidiary of Albana Engineering LLC, which is a Dubai-based entity. Okay, there's a certain promoter of the Dubai-based entity. The promoter directors of this company are the promoter directors of Indian subsidiary. So there is common control. And AEIPL, right? The Indian subsidiary was formed exclusively to execute. So there was a BPCL contract. To execute that contract, AEIPL was formed. And so what happened is AEIPL does not have any assets here. And all the funding was done by the Dubai entity. And BPCL also paid for its contract against the Dubai entity only. There was no funds received by the Indian entity. But Indian entity was executing the works here. So any creditor which was there, which was working here for the Indian entity, they find, so when CRP started and operational data triggered CRP here, and when CRP started, so these Indian claimants filed their claim on Indian entity which underwent CRP. But finally they got to know that there are no assets in this Indian entity, it's only like a shell company. And then they approached NCLT under section 60 subsection 5. And there was certain bank guarantee also which was given to BPCL, since BPCL gave a contract to this Indian entity, and there were financial terms. There was a bank guarantee available with BPCL just in case the entity defaults in performance. BPCL could invoke the bank guarantee. So in this case, what happened is, since the Indian claimants understood that Indian company is a shell company and they cannot derive any value from it by filing claim, they approached NCLT, and NCLT was faced with the question whether Dubai-based entities assets can be included for conducting CRP of an Indian entity, whether that BPCL's bank guarantee invocation can be done to get the compensation and give it to the Indian claimants. So there was a very positive judgment which came here from Honorable NCLT, right? So a lot of issues were evaluated by NCLT. One is whether the assets of the holding company can be utilized. So the Dubai-based company, whether the assets of the Dubai-based company can be utilized for settling claims of creditors arising out of CRP. So NCLT said that this is like a case of group insolvency, and we have to consider there is a common control, management, and 100% shareholding by the parent entity. So the assets of the parent company are not different and distinct from the asset of the Indian company. So they say this is a case of group insolvency. Whether instant case is fit case for piercing corporate bill, again, NCLT said management is same, ultimate promoter is same, right? They are interconnected, interwoven, and interlaced to a greater extent. There is no revenue for the Indian entity. The obligation of each other are also intermingled and have to be treated as one single economic entity. Thus, assets and properties, including any claim, interest of Dubai entity held through Indian entity, will have to be said to be the property of the corporate debtor for the purpose of present CRP. They are saying whatever is of the Dubai entity, you have to take it as assets of the Indian entity to have an effective resolution. Accordingly, in order that the parent company cannot get away from obligation towards the contractor supplier engaged by Indian entity, and taking into account that there are no worthwhile assets in the name of Indian entity, the adjudicating authority decided to consider assets of both Dubai entity and Indian entity together for the purpose of CRP, right? So, like in this case, they went a step ahead and they said that Dubai entity's asset should also be considered as our asset, and so that there can be compensation to all the creditors involved. And here NCLT then directed BPCL to invoke bank guarantee of whatever 24 crores was present and to keep the proceeds as a fixed deposit with NCLT. They basically said you secure this amount with us and we will see how to distribute it later. So again, they touched upon a group entity to secure the CRP of an Indian entity. Then you had a ERA infrastructure case. It's a huge case. 16,851 financial creditor claim was there. 758 crores, 758 crores of operation creditor. So it was a huge case. 2017 it was admitted. I think it was one of the very first cases which was there, which took a long time to resolve. So we've given the timeline here. So NCLT admits case against ERA infrastructure in 2017. NCLAT dismisses NCLT order as some demand notice was not issued. If you remember, Macquarie Bank case also came out somewhere in 2018 on demand notice. So 2017, NCLAT dismissed NCLT's order admitting CRB. In 2017, RBI then identified the 12 large cases, which we call as the 12 largest defaulters. June 2017, Union Bank of India files insolvency application against ERA. July 2017, promoters of ERA move NCLT against Union Bank's insolvency proceeding on the ground that many winding up proceedings are pending in High Court. Then they seek clarity if NCLT can override High Court. August 2013, NCLT refers jurisdictional question to a larger bench. When a question of law comes on jurisdiction, they always refer to a larger bench. Then February 2018, the special bench says there is no bar on NCLT to trigger insolvency proceeding, even if binding proceedings are pending. So this used to be a very repetitive question in those times. Then whether, if there is binding a proceeding pending, can NCLT take up any insolvency petition? And then the law became clear with a lot of precedents that, unless and until the complete binding up is done, NCLT can definitely entertain such petitions. Then May 2018, insolvency application of Union Bank was finally admitted by NCLT 11 months after RBI had referred the case. August 2018, the RP invited expression of interest from bidders. Plans could be submitted till 6th November. September 2018, ICICI Bank moves NCLT against rejection of its claims by the RP. December 2018, NCLT finds merit in ICICI Bank's petition and asks RP to include 700 crores loan to ERA Infra subsidiary and SPV's financial debt. So ICICI Bank gave loan to ERA Infra subsidiary and SPV. So NCLT directed RP to consider that loan as a financial debt in ERA Infra case. March 2019, ERA's Infra resolution period was extended on plea of resolution professional as income tax seized a lot of documents. And so you can see when we brought out the law, there are so many issues being faced that it dragged on for like years and years together. Then going forward, May 2019, NCLT rejected ICICI Bank petition seeking insolvency proceeding against one of subsidiaries of ERA. June 2019, NCLT orders lifting of freeze on bank account at the request of Commercial Tax Department. These accounts were frozen since 2017 and 2019 only they were released. July 2019, ERA Infra went through 2 rounds of bidding. Both time they got 2 resolution applicants, Suraksha ARC and one more. Resolution applicants want to also bid for 6 SPV which are separate legal entities. So the RAs wanted 6 other SPVs also which are separate entities. A lot of times, as an investor that, the main asset is in maybe the investments which are into SPVs, and SPVs have large land banks. So the investor also wants, certain SPVs control to make it viable for him. November 2019, COC sought to see clarity if the plan can include assets of SPVs. March 2020, after hearings on the case, NCLT had kept one date as a last hearing. Then NTPC moved Supreme Court. You had COVID and all these things coming up, right? Then NTPC moved Supreme Court against RA decision not to include arbitration claims. So a lot of things happened. ERA was an EPC based company, and any EPC sector you take, you will have 2 or 3 SPVs at least. One might be doing a O&M contractor, one something else, one a supplier of equipment. So you will have different group structures working in tandem with each other. They will have always set up the structure to have cross billings and cross sharing of resources. So typically as an EPC company, when ERA gets contacted for a project, they create an SPV and lenders fund the SPV. Because of these interlinkages, a large part of value are stuck in SPVs. So that's why the RAs also want SPVs. So when you go to the market, you realize that there will be no interest in ERA Infra as a EPC company on a standalone basis. So if you see Lanco Infratech holds large part of values in its SPVs. Lanco is also a big EPC contractor, but when they take out project, for every project they create an SPV, there is infusion in the SPV. So standalone Lanco might not have any value because it's like a holdco or investment holdco. Like if you take GVK Energy, it's like a GVK investment, sorry, it's like an investment holdco. They hold shares in different subsidiaries, right? They might not have a revival prospects on their own, but the SPVs will have a lot of value. So RS will be interested in taking out the value of the SPVs. So even if there was some interest from ARCs, it may be to milk the arbitration and other favorable claims. Normally in these EPC contracts or power sector, infrastructure sector, there are a lot of arbitration and actionable claims which might be there, which can be. So third party litigation funding is a very new concept being developed now. In abroad, it's already there. Here, it's picking up because of this NRRA and new things coming up. So in these EPC contract and infra contracts, there will be large arbitration claims, some case dispute going on. So ARCs and different kind of litigation funders might be interested in picking up those actionable claims to make big money, buy it cheap and then make big money. They will not be interested in a standalone uh, resolution of ERA infra. They might want such actionable claims. Another difficulty is that in delaying the resolution is that ERA infra's entire worth is in disputed receivable, and all of those disputed receivable have been arbitrated. The legal question that COC faces is whether the plans that they have received provide them legal authority to merge SPV with the holding company and sell it to either of the bidders. So whether they went to NCLT to ask whether I can take the SPV's asset also to merge with the holding company while selling to bidder. So this question, there was no clarity on it also coming from NCLT, whether this can be done or not done. And this never met the fate of it. But we had some interesting things touching in this case on group structures. So basically here again, like in that Dubai entity case, we discussed that NCLT allowed the company to include assets of Dubai entity for its resolution. So here also similarly, there was a query on whether an SPV asset should also be taken into it. In Lanco Group, when this case happened, there were so many lenders. There were like 40 lenders in LITL level. Okay, when you had LITL in CRP, there were 40 lenders. Plus different SPVs were going into different CRP process. There were different lenders and COCs there. Most of them were on account of corporate guarantees. So people would have lent to SPV, would have taken a corporate guarantee from Lanco. So they would have been sitting in COC of SPV also and COC of Lanco also, right? And in all of these cases, it's, you can say unfortunate or you can say that's how things work. But every lender wanted to make the most in both the areas, in LIT level also, in SPV level also. And they did not want to budge on their expectation. They wanted to make the most in both the areas, and which impeded the resolution. They did not want to merge the asset. SPV might have PPA, live PPA. So SPV lenders might have a different greed or different interest in protecting their value. They might not want to consolidate the claim with LATL level, which dilutes their claim. So these things really impeded LITL's resolution prospect, which ultimately went into liquidation. So here in ERA also, most likely what I remember is this went into liquidation, and there was no clarity given by NCLT on this issue whether SPV's asset can be taken. Now coming on to Lavasa's case, this judgment we'll read Lavasa's judgment. A lot of interesting things in the judgment. Basically, Lavasa's ARP, Lavasa was one of the first, you can say a smart city or a concept city which was built in very close to Bombay and Pune, and it picked up very well, but then ultimately defaulted and went into insolvency in 2018. CRP of Lavasa started. It had two subsidiaries, WAML and DCCL. They were also pushed into insolvency. So Lavasa was into development of hill station and had total 49 subsidiaries. WAML is a wholly owned subsidiary of Lavasa, incorporated to design, develop, engineer, finance, and maintain transportation infrastructure and project facilities. So basically for, its name was Varasgaon something. So it was for transportation infrastructure for the Lavasa township. DCCL was incorporated for running and maintaining convention center. So they built one convention center there, and DCCL wanted to uh, maintain that convention center. So all the three had gone into different CRPs. Now DRP and WPCL were not in CRP, but debt resolution was queried. So let's just go to the judgment here. A lot of interesting paras, and this judgment was upheld by NCLAT also. So we can say that this has stood the test of law. I think it should be visible now. So Feb 2020 judgment. Yeah, the company's name, subsidiary's name is Varasgaon Asset Maintenance Limited for the transport, and DCCL, which is your Dasway Convention Center, right? So these are the three entities here. So we can also even see 17 page only, we can see the entire judgment also. So applicant here sought applicant was Axis Bank, L&T Infrastructure, Central Banks, all the lenders, right? And they were financial creditors of LCL and WAML also. So they sought consolidation of respective insolvencies of LCL and two of its wholly owned subsidiaries, which was WAML and DCCL, right? They sought a direction for reconciliation of the list of creditors of all these three entities by respective RPs appointed under CRP. They sought consolidation. So they are saying consolidation of CRP of all these three entities and submission approval of one consolidated resolution plan. So they want one plan, one RP, and probably one COC. So then the brief facts come up. Right. RP of Lavasa mentions that the RA, in their proposal to submit plans of Lavasa, had proposed that as a precondition, the entire group debt with respect to Lavasa Group Company should be extinguished instead of standalone debt of LCL. So the investors are saying that against our proposal, the entire group debt should be extinguished. However, the applicant mentions that taking a call on these conditions are not within control of Lavasa because it relates to the other entity. So how can I take call for them? The applicant mentions that WML is 100% subsidiary and its sole business is to manage infra of Lavasa and therefore directly interlinked. Contract under which the infrastructure is managed could cease to have any force and effect after LCL resolution and liquidation and would leave WML as an entity without any business or revenue stream. It is further submitted that the applicant that the lenders of WML had provided the loan to WML for the purpose of funding payment of security deposit payable to LCL. So WML had to give security deposit to LCL, and to give the security deposit, lenders of WML had provided the loan for WML, and lenders are same. We are saying also that WML is a 100% subsidiary of Lavasa. DCCL undergoing CRP since 5th February 2019 does not have any financial data as the property belongs to Lavasa and its sole business is to operate the convention center located in Lavasa city. So again, this entity also does not have a different business. Its revenue also comes from Lavasa city only. Then you have Varasgaon Power Supply Limited, WPSL. WPSL is a wholly owned subsidiary of Lavasa, though not undergoing CRP, has only one financial creditor, L&T Infra, which is also among financial creditor of Lavasa. Entire financial debt of WPSL has been admitted as a financial debt of Lavasa pursuant to corporate guarantee and security provided by Lavasa to lender of WPSL. So basically, I think that entire financial debt of WPSL, although WPSL is not into CRP, but entire financial debt of WPSL has been admitted as a financial debt of Lavasa pursuant to corporate guarantee security provided by Lavasa to WPSL. Because Lavasa as a holding company has given a corporate guarantee to lenders of WPCL. Those lenders, when CRP initiated in Lavasa, those lenders came and claimed as a for on account of corporate guarantee. WPSL is 100% subsidiary and its business is to develop, operate, and maintain power of Lavasa project. Again, it's all interrelated. Similarly, there was one more entity, Dasway Retail Limited, again a wholly owned subsidiary. It has only one financial guarantor, Central Bank, which, like DCCL, that convention center, is also among the financial guarantor of LCL. So financial guarantors are same. Entire financial debt of DRL has been admitted as financial debt of LCL pursuant to corporate guarantee. Very similar to what we saw just above. Here also corporate guarantee was given by Lavasa on behalf of a loan taken by DRL from bank. So that bank also claimed in Lavasa's CRP. Along with the applicant, COC of WML through the resolution professional have submitted that the resolution should be consolidated. So the other entity is also saying that you should consolidate. It's very important that the other side is also consenting to it. It appears from the facts mentioned above that lack of consolidation of CRP of these corporate debtors, which are already under insolvency and resolution of the debt of WPSL and DRL, can only happen along with LCL, who is the corporate debtor and owner of the township. Any standalone resolution does not seem to be possible and would therefore defeat the objective of the code, which is to maximize the value of corporate debtor. In case of DRL and WPSL, which are not under insolvency, resolution of its debt is directly linked to the resolution of Lavasa. The debt of DRL and WPCL on standalone basis can never happen, and only when it is consolidated with LCL that resolution may happen. However, this bench is aware that these two entities are not undergoing insolvency. So just think of the complicated circumstance which the bench is faced with when the law is so new already, right? In case of LCL group companies engaged in development of township, like provision of standalone captive power, which is given by WPSL, transport given by WML, right? Convention center by DCCL, running the retail operation by DRL. Therefore, the interlinkages and synergies between these companies to keep Lavasa as a running township cannot be overemphasized. And therefore, to achieve a more value maximization deal, it becomes imperative that any resolution applicant bids for these interlinked good companies by way of single offering, which would result in achievement of higher value. As has been mentioned in the application of consolidation, most of the resolution applicant has put consolidation as a precondition to a resolution plan. However, if all above mentioned group companies are resolved in consolidated manner, a much more value maximizing resolution could be achieved. This case for consolidation of CRP of various LCL group companies is akin to insolvency resolution of different Videocon companies. So they refer to Videocon case also, right? Then they go to the yardstick or criteria, those 14 criterions for seeing whether group insolvency should be there or not. So on common control, they say WAML, DCCL, WPCL, DRL, they're all wholly owned subsidiaries. Each company has same registered office. Further, they reported a common email to MCA. Common directors, master data available on MCA, details indicate common directorship, common assets, WML, DCCL, WPCL, DRL, they operate a common set of assets and office infrastructure owned by Lavasa. Common liabilities, the entire financial debt of WML, DRL, and WPSL is guaranteed by Lavasa. The claims of financial creditor have already been admitted by RP of Lavasa. Interdependence, taking into account the business of Lavasa and all these entities, as well as the agreement executed between them, it is evident that there is substantial interdependence amongst each other. The business of each of these are interlinked and intertwined to the extent that the fate of WAML, DRL, WPSL depends greatly on the outcome of Lavasa. So everything depends on resolution of Lavasa. Interlacing of finance. As far as WAML is concerned, there was a financing arrangement between WAML and Lavasa, where Lavasa had agreed to provide third-party security interest, including mortgage, to secure the financing available by WML. So interlacing of finances, because WML took a loan, Lavasa gave a third-party security interest. L&T, which is a financial creditor of Lavasa, is the only financial creditor of WPSL. Similarly, Central Bank, which is financial creditor of Lavasa, is the only financial creditor of DRL. So basically, there are interlacing of finances. Then pooling of resources, they depend on common set of sources. Coexistence for survival. They have to work together to run that township, right? And then intricate link of subsidiaries, consolidated accounts, pooling of resources, common assets, and interdependent business functions. There are examples of intricate link of subsidiaries. Intertwined accounts, application contains the report on consolidated financial statement of Lavasa, its subsidiaries, its associates, and JVs, which comprises consolidated balance sheets as on 31st March. Interlooping of debt, WPCL, DRL have only one financial creditor, each of which is also financial creditor in Lavasa. Entire financial debt is guaranteed by Lavasa, and claims of financial creditor in this respect has already been admitted. So there is similar kind of debt. Singleness of economic units, again, they all run for the hill station. Without even one of them, the hill station cannot operate properly. Common group of debtors, there will be no increase in total financial debt to be resolved on account of proposed consolidation. The entire financial debt is guaranteed by Lavasa and claims have been admitted. So there is commonness, right? So they went on into detail in all the 14 parameters. Then they say that, however, since DRL is not under CRP, so we read the two entities were not under CRP. Since DRL is not under CRP, consolidated COC of LCL, WML, DCCL were the sole creditor of DRL. Member may discuss their issue and take a call on consolidating it with the consolidated resolution plan. They are saying since DRL is not into insolvency, the member but the financial creditor of DRL is the sole creditor of DRL is already sitting in the COC. They can among themselves discuss and take a call on how to take this forward. It is clear from the above that the fate of each of the 100% subsidiaries depends on outcome of Lavasa's resolution. In view of the above, the bench orders the following: a consolidated CRP of Lavasa and its 100% subsidiaries, which is WML and DCCL, which are all undergoing CRP. WPSL and DRL are also 100% subsidiaries and have L&T and Central Bank respectively as sole financial creditor, who have agreed to resolve its debt as part of consolidated resolution plan. However, since they are not into insolvency resolution process, Therefore, consolidated COC of the LCL, WML, and DCCL, these three are into CRP. So, consolidated COC of these three entities may take an informed decision regarding the resolution of debt of WPSL and DRL. An initial time period of 60 days from the date of order is granted for completion of consolidated CRP of Lavasa Group. And this is how they allowed the petition. So, in 2020, to give this kind of order in such complex situation, complex circumstances, this was indeed a very good order. And but the problem is, again, you don't have a framework at that point in time. Also, you don't have clarity and you don't have a framework. So, and here the good thing is people are coming together. They're all saying, companies not in CRP also are saying that we want our debt resolution in this consolidated plan, right? But there can be situations where different creditors have different interests and they are not giving consent to such things. If the creditors, different COCs are not agreeable, then how can you enforce a group CRP mechanism? It's not possible, right? We'll just come back to the slides again. If you want a break for 5 to 10 minutes, let me know. I'll just keep continuing. Do you want a break?
That would be helpful.
Okay. Anybody else also? Let's put it on the chat box.
5 minutes break.
Sure. Sure. We can take a 5 minutes break, then we can continue. We'll meet at 3:35. Thank you. Can we start now? The participants are back. It's right on the chat box. You can start now. All right. Now, just going a bit deeper into the case laws which are available. There is one case, NCLT Mumbai, Aditya Vidyut Appliances and Aditya Fabrication. So the corporate data, so we call them AVAL and AFPL. So they were both undergoing CRP process, and insolvency professional was appointed as RP in both the corporate data. SBA was the common lender in both the cases, and they said that both these entities are heavily interdependent on one another in terms of operation. Therefore, all concerned parties should make an endeavor to arrive at mutually amicable settlement of the dispute, the larger interest and successful resolution of both the corporate data. So NCLT noted that consolidation of both corporate debtors would be conducive and would result in various advantages such as pooling together of assets of both the companies and appointment of common resolution profession and single COC member for both the companies. Thus, consolidation was to be ordered. So very plain vanilla case where they noted that both companies are interconnected, interrelated. So we just order for consolidation. Then coming on to Radico Khaitan, this is the Honorable Enclave Judgment 2021. So here CRP was initiated against a company called BT and FC under Section 9 Operational Data, and COC had SBI and Argo Capital. So one of the financial data filed CRP against, there was one more company called Bangalore Dehydration and Drying Equipment Company, BDD ECPL, right? So this was also admitted into CRP. So you are having two CRPs, BT and FC and BDD. So we can simply call as BDD. So BTFC and BDD, they were both triggered into CRP. BTFC had leased out its land to BDD, and BTFC was operating a bottling plant in that land. So one CRP entity had leased out its land to another CRP entity and was operating a bottling plant from that land. So an application for CRP was consolidation of CRP was filed, which was rejected. Appeal was filed before Honorable NCLAT and appeal was allowed. So we'll just look at the order. So this is a NCLAT judgment. So that's the company BTFC and BDDC. They were both in CRP. Consolidation was requested but rejected. All these are basic facts of default and everything. So appellant had filed IA under section 65 of IBC with Rule 11 of NCLT rules, seeking an order for consolidation of CRP of BTFC and BTD. It is stated that the respondent number 2 operates as a land holding company of respondent number 1 without carrying on any business activity. Respondent number 2, which is that BDD, owns immovable property bearing something, set up its bottling unit thereon to undertake activity of blending and bottling unit. So basically, one company leased out land to another, but and having a manufacturer, the other one having a manufacturer in its leased land. Just coming down many facts. Now here they say, we are of the view that NCLT Bombay bench in the case of SBI Videocon had rightly laid down certain parameters while ordering for consolidation of CRP. The said order was cited before NCLT Bangalore bench. However, while passing the order, there is no finding whether these parameters are fulfilled or not. So we saw one order where that they cited the Videocon case and all the 14 parameters whether fulfilled or not. That was not done here. Then NCLAT goes on to check those parameters. They say on common control, both the companies are promoted by a single promoter and they hold approximately 77%. Common directors, they say that the husband and wife both are directors in both the companies. Common assets, they say respondent number 2 owns a partial of land and has constructed warehouse on the land. Respondent number 1, company runs a bottling plant unit in that land and owns the plant and machinery therein. There is interdependency between the two companies and the assets are common to the extent that respondent number 2 company has provided its land and warehouse to respondent number 1 company to carry on its business activity. Common liability, they say that respondent number 3 has made a claim of 13 crores against respondent number 1 as a borrower and respondent number 2 as a guarantor for a collateral like corporate guarantee. So there is common liabilities. Interdependence, both because land and bottling plant, they are all interrelated. Without the one, other will not run, and they cannot function. They are interdependent. Pooling of resources, undisputedly, directors are common, using their contacts and relationship to run both the companies. So there is pooling of resources. Intricate links between the company. Respondent number 2 is an associate company of respondent number 1. This fact is admitted by respondent number 3 while submitting its claim form. The fact is also mentioned in the status report. Thus, it's clear that they are associate companies. Then they went on to Companies Act definition of associate companies. Common financial criteria, they say that lenders are the same, right? With the above said, we are of the view that respondent number 1 and 2 fulfill the criteria of consolidation, and NCLT has not appreciated the facts of this case in the right perspective. We allow the appeal. We direct NCLT to appoint a single common RP or liquidator who will carry on the duties and perform the function of the RP or liquidator in accordance with the code. Hence, the appeal is allowed. So here is a case where NCLT rejected and NCLAT dismissed NCLT's rejection and asked the consolidation to be effected. One more interesting case. This is on KSK Mahanadi, right? So KSK Mahanadi Power Company Limited has a 3600 megawatt power plant in Chhattisgarh, right? And it supplies electricity to almost 4 states. It's a huge company, huge power capacity. This is also one of the largest, undergoing CRP. This is still undergoing CRP. One of the largest debt exposure, around 40,000 crores debt exposure is there. And KSK Mahanadi was admitted into insolvency. Its 2 subsidiaries were also admitted into insolvency. Now all these 3 kind of work in a group structure. While Mahanadi is a power plant, one of the subsidiaries operates pipeline infrastructure to transport water from a river to the power plant of Mahanadi. And one of the subsidiaries operate a railway track to transport coal from the mines to Mahanadi's plant. So these 3 work in this manner in a group structure. Right? All these 3 entities were admitted into CRP on different dates. Mahanadi was admitted in October 2019. What this your subsidiary for water and subsidiary for rail, they were admitted in January 2021. Same NCLT bench was there. Consultation application was filed for all these 3 companies to be done CRP together. That was rejected by NCLT in 2021. So we'll just check the order and what kind of reasoning NCLT gave for rejecting the consolidation.
Yeah, the question.
Request the participants to be on mute. Yeah. So some case laws were cited, right? And the NCLT went on to say, it has been brought to our notice that Honorable NCLAT in the case of VARC versus Sachet Infra and NCLT in Videocon case have allowed consolidation. We have gone through the orders relied by the learned counsel. In both the above cases, consultation was not sought, but joint hearing of company petitions against various corporate debtors were sought. It was at pre-admission stage. Joint hearing was allowed by common order. It was not a case that CARP of various corporate debtors were sought to be consolidated. Hence, on facts, orders relied are not applicable. In fact, if the consolidation of CRP of various corporate debtors are allowed, then it will be too difficult for the RP and COC to consolidate assets and liabilities of different companies. It's too impractical. We, being NCLT, if direct COC and RP of different companies to sit together to resolve insolvency of different entities together, then there will be a chaotic situation relating to consolidation of assets and liability of all the companies. In fact, inherent jurisdiction cannot be used to create such a confusion. Before passing order, we put it on record that the COC in all the above companies may sit together and find out common resolution applicant so as to achieve the object of maximization of asset of all companies. We, in our limited jurisdiction, cannot direct consolidation of CRB of different companies. With the above observation, instant application is hereby rejected. So they say we don't have the jurisdiction under Rule 11, right? And we cannot force people to sit together and decide. COC might sit together, decide to have a common resolution applicant, but we cannot direct. So they dismiss this application as a simple 2 or 3 page order, right? Now, coming back to the slides. In fact, this case is pending before Honorable NCLAT right now. So there is no clear judgment on it right now. Then you had the Sachet Infra case, ERC versus Sachet Infra, NCLAT judgment over 19. So Adel Landmarks was the principal borrower. CRP was initiated against the principal borrower. Edelweiss had got a corporate guarantee again from somebody else, right? And they initiated CRP against that somebody else also. NCLT rejected that, saying that since you have already initiated CRP against principal borrower, you cannot do it against the guarantor. This went into NCLAT, and NCLAT said that this is possible, and this was in fact a case of consolidation, and you rejected the admission. So I'll just show you the order as well. It's a big order, so we'll just go through the main highlights. So Adel Landmarks Limited, in consortium with 9 corporate debtors, decided to develop a certain area by constructing flats and shops for the allottees. It was submitted that the resolution process will not be complete if the total area comprising land belonging to all the corporate debtors are not developed for the allottees. According, land of all the 9 corporate debtors have been consolidated for the purpose of construction of housing projects. According to the appellant, 9 corporate debtors, appellant is Edelweiss. The 9 corporate debtors as referred above are the landholders who, in concert with Adel Landmarks, who is the principal borrower, decided to develop total area by constructing infrastructure for the allottees. So Adel is like the real estate developer, and they consolidated a lot of land parcels to build a project to allot to the allottees. Then a lot of facts, which survey number, which land, which was belonging to. So all these facts have come down. NCLAT is very particular when it wants to give a recent order. It will almost never miss any facts which will be relevant. So all these are facts. So here, from the aforesaid facts, we find that corporate debtor are corporate guarantor and also shown as co-borrowers. So everybody would have given corporate guarantee for each other. For the said reason, we find that resolution professional has rightly taken the plea that the process will not be successful if total township is not developed. Project will be developed on the land of 5 corporate debtors as referred to above as per township plan. They have rightly taken plea that simultaneous CRP should continue against them under guidance of same RP. We find that it is a case of joint consortium of different corporate debtors, and thereby a group insolvency is required to develop the township on the land of Sachet Infra. And these 5 people, or these in these 5 people's land, we have to do a township has to be built, so a group CRP has to be done. And others, and along with CRP as initiated against Adel Landmark, which is the sole developer. For the said reasons, we hold that group CRP proceeding is required to be initiated against 5 corporate debtors, right? Apart from CRP, which has already been initiated against Adel Landmarks, which is the principal borrower, right? So they are saying you have to do a group CRP. However, if the developer of the land, there are other people also. In such case, there are like 9 people, out of which 5 NCLAT mentioned, these 4. So however, if developer of land of these is common, Adel Infra in such case, CRP having issued against common developer to be initiated against them. Otherwise, allottees whose flats are to be constructed will suffer. So basically, NCLAT is saying, even though 4 developers are there against whom CRP has not been initiated, it has to be initiated so that they can also be consolidated and township can be built. Otherwise, people will suffer. So NCLAT is going in the path of justice and equity and saying you'll have to initiate CRP if at all they are not under CRP. We'll have to initiate CRP and then do consolidation. In view of our findings, and as the NCLT has failed to appreciate the relevant fact in the facts and circumstances, group insolvency is to be initiated, and in absence of simultaneous CRP against 5 corporate debtors, the township project will not be complete. Hence, we set aside the order of NCLT and remit the case back to NCLT with following direction. NCLT will admit the application under Section 7 filed by Edelweiss against Sachet Infra, Magad, Mehek, Samiksha, and Zaman Estate appoint RP of ideal landmarks as common RP in all these CRPs. Insofar as the case of other four are concerned, their matter are remitted back to NCLT. Appellant and cooperator may produce relevant agreement to show that the ideal landmarks against whom CRP is initiated is a common developer. In such case, one or other corporate debtor, if show the same, adjudicating authority on hearing the parties will admit their applications so as to enable other projects are completed of which ideal landmark is the developer. In the result, appeal is allowed and directions given above. So they gave it back to NCLT to say that you have to appoint a single RP to do consolidated CRP process. Then we have Sona Alloys CRP. So here CRP was started. This is NCLT Ahmedabad bench. I'll just open the order. It's a very short order. Again, like these orders, they developed the jurisprudence a bit by bit in group insolvency framework. So this is the Sona Alloys order, NCLT Ahmedabad bench, December 2020. Okay, so there are three companies. Sona Alloys was in CRP. There are two more companies. One is your Ganga Advisory Private Limited, and one is Neuromed Imaging Center, right? So here application is filed by liquidator under section 65, and he wants basically consolidation of Sona Alloys, Ganga, and Neuromed. Ganga and Neuromed are undergoing liquidation process, and Sona Alloys was in CRP, but the RP of Sona Alloys was like all these have to be, because major shareholding is same, so all these have to be consolidated. In this case, NCLT rejected the consolidation, right? So here they are saying, NCLT saying, evidently as a matter of record, there are three separate orders of admission against three different companies having separate entities. Further, CRP is initiated on the basis of separate cause of action, default, and amount due to different creditors. As such, when these three companies are separate entities, consolidation is not at all possible. It's a matter of record that Ganga and Neuromed are under liquidation. It is also a matter of record that 1, 2, and 3, Sona, Ganga, and Neuromed are not group companies. Hence, the question of consolidation does not arise. Though the respondent number 2, 3, 5, 6 hold substantial share in corporate debtor, but mere shareholding does not mean that these are group companies. Had it been group company, there would be a single order for initiation of CRP. Since the companies are holding separate entities, there is separate cause of action, separate date of defaults on part of corporate debtor, the CRP proceeding was initiated separately. Moreover, IBC does not provide for any consolidation of the company when companies are holding substantial shares in each other. It is seen that applicant has placed on record number of citations in case law. There is no dispute with regard to case law. However, it varies from case to case as well as factual parameters. Moreover, object is resolution and not liquidation. It is pertinent to note that substantial consolidation as a remedy should always be treated as an exception rather than as a rule. Moreover, this remedy can be an option for group companies. However, in the instant matter, the companies are not group companies but only hold substantive shares in the corporate debtor. I have investment in the corporate debtor does not make me a group company as per this order. Under the above facts and circumstances, instant application is not maintainable and hence disposed of. That is your Sona Alloys. So when you have cases which admit, you also have cases which have rejected. There are some more references, could have been, not have been, but did not proceed under group insolvency, like Bhushan Steel, Bhushan Energy. Two separate insolvency process were running, although there was strong interconnectedness, but they ran separately. Jet Airways, this was a case where it was interesting, innovative also, but here also you had Jet Airways, another entity of Jet Airways also, which could have group insolvency could have done here, Jet Light, but it was not done. But in Jet Airways, there was a situation where a coordination was set up by NCLAT, where NCLAT said, let the Dutch administrators, since you had a parallel insolvency proceeding outside also, but they gave prominence to our Indian insolvency regime. So the NCLAT said, you ask the Dutch administrator to be part of the process, he can attend the COC meeting and you share information with him. So coordination protocol was set out, and this somewhere formed the basis of your cross-border insolvency as well. Then Monath Ispat Energy and its subsidiary Monath Power Company Limited, they were admitted separately. Lenders tried a lot to bring in, sync between thing, but since there was no group insolvency legal framework, all was done based on coordination only. Adoni Group, 4 different CRPs was run. Again, there was commonality of lenders, but there was no group framework. SRC, SRC, it had a lot of subsidiaries, but it ran separately, and it was difficult for SR to have a group insolvency. Many reasons. Some was group companies had different lenders, so their interest did not match. Quite a few group companies had standard accounts. So why, when they have standard accounts, they are able to service their debt, just like ILFS. Many green categorized companies were pushed into moratorium, that they could not do business, and then Incline had to move them out of moratorium, right? So here also there were a lot of standard accounts in the group, and they did not want to be pushed into CRP. And then contractual arrangement was separate. For every group company, there was different contractual arrangement. They are all adhered to. So when SR was into CRP, operations were carried out normally, contracts were honored, and no trouble as such came because of that, following that protocol. And in fact, when resolution applicant came, he came and picked up certain subsidiaries and associate, which was essential for his acquisition of SR. Now, looking at some challenges and constraints before we go on to some latest developments and some more reports and one more case law. So some challenges and developments is related to lenders. If you see, first is, since you are a lender here, you might be a lender there or not. If you are a common lender, fine, then it's in your interest to have a consolidation. But if you are not a common lender, you are a lender in a holding, but somebody else is the lender in a subsidiary, so there is a conflict of interest. Everybody wants to maximize their own interest, right? Second is cross linkages. Now there will be so many related party transactions between these entities. It becomes very difficult to track, identify preferential transaction, and even find out some value maximization out of those preferential transactions. So when there are cross linkages, lenders also find it very difficult how to apply the group insolvency framework. Expense allocation. So if you are having shared resources, same employees, directors are being used by all the entities, how do you allocate and proportionately allocate these expenses? That becomes a concern. Lenders in holding company might not want to take the major chunk of it. They will want the subsidiaries to take it. So there will always be a fight on who will take how much of expense. Corporate guarantees, which are given by holding company or parents for loans to subsidiaries, result in double counting of claim. Same lender, I have given you a loan, I will claim when in your CRP, and somebody, your holding company has given me a corporate guarantee. He's under also CRP, I will claim in him also as a corporate guarantor. So there will be double counting of claims. Lenders wanting to maximize value from each of their CDs. So like I said, everybody will want to achieve value maximization in their respective CDs. That will impact, there will be no cohesiveness of resolution there. It will impact the entire resolution. Keeping track of multiple CRP. You have so many CRPs going on. It becomes very difficult to keep track. Double counting of claim, double process is happening. So maybe group insolvency will help you. Determining the right valuation. So when you value the unit as a single economic unit, you'll get a different valuation. When you value it separately, you'll get a different one. So these practical challenges also are on the minds of lenders when they want to think of group insolvency framework. When you come to resolution applicants, see, if it's a single economic unit, then RA will want to give one resolution plan. He will want to pick all the assets together. He will not want a situation where he picks holding company, but he does not win the subsidiary company. If there are different CRPs going on, a resolution plan might succeed in holding company, but he might not win the subsidiary company. And when control is not with one person in such a single economic unit, it becomes very unviable. Why do you even then pick such an asset, right? So these kinds of things come for the RA as well. Then adjudicating authority. If you have different benches, there can be conflicting judgments, right? So there can be overriding issues coming up, and that results in a chaos. And also, there might be so many litigations in each year. It's always better to have them before the same bench. That's why for guarantors and corporate debtor, same benches directed or stipulated under IBC code. Similarly, a group CRP will succeed only if there is common jurisdiction, a common bench hearing all the matters relating to that group. That will only help to ease out matters. Then coming on to RPs. So RPs, if they are different for the parent company and the subsidiary, that creates again a conflict. every RP would want to maximize value for its respective corporate data. And when they are different RPs in different CRP entities, their values and visions may not match. The COC might be different. So the COC's drive on the RP will be different. RP will then work according to the COC. So there will not be again, what do you say? You will not be able to synergize different group entities. Sharing of information, if there are different RPs, one RP might not share the information with other. There might be confidentiality issues. If you have friction between the entities and the lenders, then running the companies together becomes difficult because the going concern gets impacted. There might be related party contracts which are not getting honored, because of which one company stops their supplies, other company then cannot function, and then it hits the entire value chain and entire business, right? And RPs also have regulatory limitation on number of cases, so they cannot handle more than 10 20 cases. That limit is there. So if there are large groups, how an RP will be allotted to handle such large groups, that also has to be clarified. The nature of insolvency proceedings, whether both parent and subsidiaries are under CRP or only one is under CRP, or some of them are under CRP while others are not. Basically, you can have situation where holding is under CRP, subsidiaries are not, but the value is remaining in the subsidiaries. How do you resolve holding company when the value is in subsidiaries but they are not in CRP? We saw some cases where in some cases court stretched, and said that assets of subsidiaries should also be included. And there are cases where court have rejected consolidation of CRP. So clarity should come on this. Law prohibits takeover of assets of subsidiary by RP. So when you are a RP of a company, you have control over assets of the company. Assets will include investment, but not assets of the subsidiary. I can hold or treat the investment in the subsidiary to the resolution applicant. I can hand over, but I cannot touch the assets of the subsidiary which come by way of those investments. Then there can be additional costs and delays when you are doing a group insolvency framework. If you don't have a framework and you want to do a group insolvency without a framework, there are so many confusions. Will there be one RP, one COC? Will expression of interest be published once? Form A should be public once. Will there be different valuation exercise conducted, different avoidance transaction exercise conducted? Until and unless you have a clear cut framework for this, you will not be able to identify the cost which will be incurred in doing a group CRP. Now, just some illustration on Amtech Auto case. So Amtech, also a large group, major supply source for OEMs, basically original equipment manufacturer, right? It had 15 plus operational domestic plants, 7 locations, multiple operational units across the globe. And to establish ongoing communication channel, the establishing information operational control, there had to be a common structure somewhere. But they had a very complex group structure. Amtech supplied final machine product, but the key vertical horizontal integration came from their layers. So while Amtech supplied final machine product, key processes in the value cycle like casting, forging, and supply of critical assembly elements were stationed in other group companies. We saw one slide of this in the initial slides, all with their own set of problems, and majority of the subsidiaries eventually getting admitted into respective CRP. This complex structure provided promoters with considerable leverage and possible threat of business disruption by withholding supplies from feeder units housed in other promoter control units. So since some went into CRP, some were still in promoter control, the promoter could use his control to disrupt the business and affect the going concern. Given the large scale of operation, having uniform enterprise resource planning system was a necessity. However, company continued to follow old systems with individual locations running their preferred ERP. There was no uniform ERP. No uniform MIS existed to track metrics at the company level. Most of the plants had their own format for business reporting and resulting in many Excel sheets running parallelly in different formats, right? When Amtech was getting resolved, all these problems were being faced by Amtech's RP. Lack of apt and uniform technical support resulted in coordination issues between key functions impacting overall business growth and sensibility. Complex business structure required involvement of multiple related parties. One equipment component is coming from this group, one from that group, then an assembly from this group, forging from that group. So they have created such a complex structure. So multiple related parties were involved. These interlinkages worked back both ways with the supply entities, majorly dependent on the corporate data for their sales. These entities, smaller entities, are dependent on the holding company for the sales. As such, ongoing stress at the corporate debtor was evident in the back-end entities as well, hampering their operation, further impacting the operation of corporate debtor. So I am the holding company. You do the forging, you sell to me. So I am your main customer and I pay you money and then you operate further. I am into insolvency. So whatever you are supplying to me, I'm not able to pay you. Your operations are hit. And in return of that, my operations also get hit because I depend on your supplies. So there is a cascading effect and there is a vicious circle. Subsequently, most of these back-end entities were also dragged into respective insolvency. So these were issues faced by RP in Antec audit. Now, coming on to one more interesting case, was like case came Anadi case. Like I said, uh, so this is still sub judice going on. Okay, so Mahanadi is the power plant, and you have two more subsidiaries. You have Raigad, Champa Rail Infrastructure, and you have KSK Water. So basically, let's call them water and rail. So Mahanadi power plant and water and rail are two subsidiaries of Mahanadi. One transports water from river to plant, one transports coal from mines to plant. So here basically what happened is, since these kinds of entities, SPVs are set up to have new fund infusions. Like I said, when you exhaust your loan sanction in one entity and you require expansion, you create another SPV, you take fresh facilities, fresh loans, you have corporate guarantees from the holding to subsidiary, all those things happen, right? So these three entities were supposed to operate as one value chain. Okay. And in one stage, they even went for a merger proposal where merger was approved. And since the merger was approved, the subsidiaries were not billing the holding company, and the holding company was servicing the debt of the subsidiaries in lieu of the billing. So all this was happening. But then Mahanadi went into CRP because he's defaulted on its loan. And when Mahanadi went into CRP, it stopped paying the debt servicing of subsidiaries also, because of which the subsidiaries also got pushed into CRP process. Right. So all the three companies went into CRP with different RP in different timelines. So they have distinct CRP, they have distinct COC. Lenders who gave loans to Mahanadi were also lenders in water and rail. But as they went forward, they assigned their debt to somebody else. Now somebody else has taken over the debt. So you can't even call them as common lenders. Okay. So they have distinct COC, distinct CRP, distinct RP. Okay. And this subsidiaries, since they are under distinct CRP, they have to run as a going concern. They also have to value maximize. So they, because until date, on the basis of merger proposal, invoices were not being raised, and there was no revenue model, in fact, for the subsidiaries. So RP is instructed by the COC to raise invoices on Mahanadi. And Mahanadi says, no, I'll not pay because we've been not paying since so long. Then this case goes to NCLT. NCLT directs Mahanadi to pay as per contract, right? And that it's a different CRP. Section 14 subsection 2A is there. If you are using something critical for protecting your assets, then you have to pay for such usage during moratorium. So Mahanadi is directed to pay money as per contract. Then it's appealed in NCLAT. NCLAT also upholds the order saying that you have to follow the contract. The case is pending before Honorable Supreme Court. Now, here there are so many issues. Since CRP is distinct, RP is distinct, he will have to run the company in the best interest of its stakeholders, not Mahanadi stakeholder. Mahanadi will not run as per rail or water stakeholder. Water will not run as per the wishes of Mahanadi stakeholder. So all these issues cropped up. Lenders, although originally might have been same, but they assign debt in subsidiaries. Once you assign debt, it goes to somebody else. Now that party has a different interest. He will not have a common interest. Okay. Bills were not raised because of merger proposal. That does not mean the new RP was come in under CRP will not raise the bills, because there's a contract and you have to pay as per contract under section 14.2. Right. Now what happens to those invoices which were not raised? What happens to GST liabilities of those invoices? Okay. And here also you had court judgments based on which money was paid, but till that date invoices were not cleared. What happens to those belated filings? So a lot of new issues, practical difficulties started falling out. Now, for any consolidation to happen, although coach might say anything, right? They say common control, common director, all that is fine. But shouldn't there be consent of committee of creditors? So committee of creditors of all these three entities should agree And in any case, you see where it's allowed, normally you have seen that creditors were same and they wanted consolidation. So consent of COC in all the entities should be there to facilitate a consolidation of CR. If that is not there, there is no talk about, because commercial wisdom of COC is non-justiciable, it cannot be transcribed by the court, they cannot get into the commercial wisdom of COC, all those things are there. So if commercial wisdom of COC does not consent for consolidation, then there is no point in talking about them, right? So these interesting factors do play out. Now coming on to the new report, right? December 2021, CBARC gave out with a report. It was constituted by MCA, and they submitted again some more recommendation on group insolvency. So after March 2019, it's December 2021. In this framework, now they have touched upon the group definition. A broad and inclusive definition of group should be provided so as to include a large number of corporate debtor within the ambit. The definition of group may be based on criteria of control and significant ownership, not just holding subsidiary, right? It says look at control, look at significant ownership. This definition should be applicable to all the entities that fall within the definition of a corporate debtor, whether it's company or limited liability partnership. The group insolvency framework under the code should only apply to a company under whom which is under a CRP or liquidation process is ongoing through procedural coordination mechanism. So jurisprudence evolved out of orders of NCLT enclared on Honorable Supreme Court is to be taken as an input. CBRC report on group insolvency explained that adopting the purely single entity approach in the insolvency of group members may be divergent from the economic realities of the group as viewed by stakeholders. So if stakeholders view it as one single unit, all the entities as one unit, but if the law sees them as different independent units, it might be counterproductive, right? So we can just have a look at the report also just to see some more recommendations which were there. Let's see the executive summary. Summary of recommendation of committee. A group insolvency framework that is voluntary, flexible, and enabling in nature should be provided under the code. Such a framework may be introduced. Such a framework may be introduced in phases. In the first phase, only provisions governing domestic group insolvency may be enacted. Then jurisprudence on substantive consolidation, pooling of assets and liabilities of insolvent group is already developing under the code through case law. This is a remedy resorted to in exceptional circumstances, and provisions governing substantive consolidation may not be provided into the present. The need for such provisions may be contemplated at a later stage on the basis of practice. Mr. Pawan, I'll request you to keep on mute, please. The need for such provisions may be contemplated at a later stage on the basis of practice and jurisprudence evolved in this regard. In the group insolvency framework, a broad and inclusive definition of group should be provided so as to include a large number of corporate debtor within the ambit. The definition of group may be based on criteria of control and significant ownership. This definition should be applicable to all entities that fall within definition of corporate debtor, be it companies or LLP. The group insolvency framework may not apply to financial service provider under Section 227 of the Code. The group insolvency framework should only apply to corporate debtors. This we read. A list of procedural coordination should be available under group insolvency framework, which is given below. They talk about the filing of joint application. All proceedings relating to corporate debtor may take place before the same bench. Common insolvency professional may be appointed. A group COC may be formed. COC and insolvency professional appointed belonging to same group should mandatorily be required to cooperate, coordinate, and share information with each other to deal with the issue of information asymmetry. The law should enable group coordination proceedings for corporate debtors belonging to same group. Participation of company in group coordination should be voluntary, and COC should have flexibility to opt in to the group coordination proceedings. Group coordinator shall constitute a group COC consisting of suitable representatives. So you should have group coordination committees, right? Then a group strategy should require approval of all participating COC by 66% of each. When a corporate debtor participating in a group coordination proceeding is undergoing liquidation, the liquidator should decide whether to approve group strategy or not. A group coordination proceeding shall terminate if the group coordinator applies for a termination order. So they are talking about coordination, flexibility. The cost should form part of insolvency resolution or liquidation process cost of the participating group members. Specific provisions to deal with perverse behavior may not be required, as provisions dealing with avoidance action, fraudulent, etc. of the code are sufficient. Detailed provisions in group insolvency scenario should be legislated based on practices developed in due course. Effective capacity building measures and use of technology is required. So all these things are common basic recommendations given by the committee. Now, after this report came, MCA also came out with a consultation paper in January 2023, where they have asked for consulting public on what amendment should we bring in. I'll just share that screen. So this was Jan 2023. There, among many other things, they then talk about interdependence of corporate data. So this is the clause resolving interdependent entities. Interlinkages, especially those owing to related party transactions, may be prevalent in corporate groups. There are situations where a company is linked to one or more companies in terms of operation finance, all of which may be in financial distress. It is suggested that where separate CRPs are concurrently ongoing in respect of multiple CDs, which may belong to the same group, the cost of extricating interlinkages may increase with the duplication of effort by stakeholders across each CRP. In some cases, the cost of disentangling the interlinkages may be high. This is the same language we saw in the report. At the same time, such interlinkages might be beneficial for value maximization and continuing all the concerned companies as going concern. Therefore, dealing with these companies in a consolidated manner is like to have significant benefits in terms of improved synergies, cost efficiencies, and value maximization. Presently, the code is silent in conducting consolidation of CRPs of related party in a consolidated manner. However, some cases adjudicating authority have consolidated CRP proceedings to maximize benefit. In such cases, CRPs are being conducted concurrently by single RP. This ensures higher possibility of revival, improved procedural coordination, and better value realization. Thus, it is being considered that there may be a common NCLT and IP for CD and its related party in such cases. For this purpose, related party shall be limited to a body corporate which is holding subsidiary or associate of the company, or a subsidiary of a holding company to which CD is a subsidiary, means common subsidiary, as referred to in section 524. Similarly, related party of LLP will be as referred in section 524. Further, COC of 2 or more CDs may apply to the NCLT seeking cooperation and coordination of CRP. So committee of debtor of 2 or more CD can also apply to NCLT. Where NCLT passes order, CRP of 2 CDs shall be conducted by the procedure specified by IBBI, which shall provide the details related to coordination and cooperation. It is also being considered that the code may be amended to provide a detailed framework for domestic group insolvency procedure. The report of CBIRC under the chairman of Dr. K.B. Gibson may be referred to. So they refer to the report. Right. So this came from MCA. Now coming on to so I'll just show you the order, very recent order on group insolvency. And this is from Honorable NCLAT. So here basically NCLT rejected consolidation request. Okay, this is Regan PowerTech order, Honorable NCLAT. So very detailed order. Again, they go into all the sections 18F, 36, and which country provides what for group insolvency. After seeing all that, they say NCLT should not have rejected. And it's not a equity jurisdiction. Consolidation is for the benefit of, so they refer that BTFC case, Radico Kaitan also. So they say consolidation is for the benefit of value maximization, and NCLT should have allowed consolidation. Just try to see the, yeah. So it's a very long para. So they talk about a category of them as operational criteria. Okay. And then they say keeping in view the parameters of Radico Kaitan and one more case for consolidation with respect to common control, common director, etc. and this is largely unsatisfactorily met, then they say they can be treated as single economic unit. The approval of COC and having regard to report of mediator appointed by NCLT, the recommendations of working group, the report, the extract of executive summary published by MCA, the tribunal is of the considered view that consolidation of CRP be allowed. Needless to add, tribunal has not made any observation on the merits of the claims, while some of the appellants are financial data. So they are not going to merits of the claim. They are saying it should be allowed. So in this, there's just one very good statement. Basically, where they say that, yeah, have ordered the consolidation of sale, but the NCLT, while referring to these decisions, has wrongly concluded that finding with respect to consolidation was done only in equity jurisdiction, which the tribunal does not possess. It is vehemently contended that consolidation simultaneous ARP was ordered in the first cases not in excess of equity jurisdiction, but to retain commercial viability and maximization of value of asset. So a stand was taken that earlier case which admitted consolidation was on equity jurisdiction, right? And courts does not have, NCLT included does not have equity jurisdiction. You had E.S. Krishnamurthy case of Honorable Supreme Court. So they said that, it's contended that these orders were wrong. But the other side said these orders were not in equity jurisdiction, but for commercial viability of and value maximization of the business. Right. So basically, NCLAT said we are doing consolidation for value maximization, not for equity jurisdiction. So you cannot reject based on that ground, and then they allowed the consolidation. Right. So to conclude, what I can say is we have predominantly large number of group and layered structured transaction approach. In India, you see that there is a report which says that I think 80%, or there was some figure that 80% of the business in India are done through related party transaction, and there is a ranking for related party transaction in which India stands pretty high on the ranking. So a large percentage of our companies follow the group structure. There will always be SPVs, related entities, associates through whom the transactions are routed, right? And there might be genuine transactions also. So there is a strong interconnection between all these entities financially and operationally. And there is such level of interdependence that one cannot work without another. So when these things are existing, when we know that these complexities are existing, then we have to see as a comprehensive approach how to tackle this problem. One entity might be in CRP, one might not be in CRP. But this CRP entity cannot be resolved without taking the assets of the non-CRP entity. Then how do you approach such situation? How do you approach the situation when group entities are under distinct CRP with different COC and different RPs? But when they are fighting with each other, they are in fact reducing the value which could come by a group resolution. How do you approach such situations? How do you protect lenders of distinct COC from being forced into a group CRP? If they are assigned lenders, then they have a different interest, right? They are now acting in a different role. How do you protect their interest? So there is, since till the time there is no clear-cut framework on this, a lot of uncertainties will be there. So courts have stepped in. Courts have given some framework. They laid down some parameters. They have started the work. And until and unless law makes it clear, there will be confusion for all the stakeholders involved, including investors, including bankers and the resolution professional, and even NCLT as well. How many cases will they pick up and keep on litigating, and how many different benches can take one single matter on hand? I mean, cost of action can be many, and many might be in different jurisdictions. So it will become very unfeasible to have different benches deciding on those matters. But before doing a group insolvency approach, a cost benefit analysis for every case has to be done. Each case will have a different set of circumstances existing, different set of facts, and different, not necessarily that in Sona Alloys we saw, just because I hold shareholding, I do not become, you cannot just consolidate me for that. So each case will have different sets of facts and circumstances. You have to do a cost benefit analysis to see whether group insolvency will really benefit all of them. If it does, which lender will say no? If it doesn't, you cannot force them. You cannot force commercial wisdom of COC, right? And till that time, that legal clarification is coming, we have court judgments which are, If COCs are different entities moving courts asking for cooperation, courts are allowing it. So till the time that's happening, but you need a framework, clear-cut framework very soon. And this vis-a-vis, a cross-border insolvency, which is not picking off because of many reasons, group insolvency framework will definitely come into the play, right? A lot of amendments are proposed and it might happen soon also. And because we have that complexity existing and because of which resolutions are not happening, large cases like Lanco, maybe GVK, many large cases, SR, all these cases are affected because you did not have a group insolvency framework in place, right? Now, when you bring in an insolvency framework, the existing cases which have taken off their own separate courses, how transition will be brought for them, it's something very uh, very significant how we are going to address that. But at least going forward, any group cases come, there should be some like MSME prepack framework, right? So similarly, special resolution framework is allowed under law. Any government can bring by notification a special resolution framework under section 240. So similarly, here also there should be some allowance under law, some flexibility given under law to approach, so that tomorrow if a group entity wants to go into insolvency resolution and they know that this has to be resolved as a group, they should have a approach and a remedy under law. So that's it from my end. Now it's open for question and answers. If you have any questions, feel free to put it on the chat box. You can one by one, you can open your mics and speak also. You can tell me, I can open the mic as well. Let's just see if there is any chat already existing. So Mr. Narendra has written, I'm proposed IRP in one real estate matter where a company is allotee of land and in JV with B allotted the inventory, collected money later on A and B both authorized company C to further allot, all committed default, all committed default as on date. All committed default as on date and no construction on site. Please advise whether it will be case of group insolvency. So you are saying one company is allotee of land, another company holds inventory. They collected money. Later on, they both authorized the company to further allot. And all of them committed default. And there is no construction. So there's a real estate case, there is no construction on site. Of course, it can be a case of group insolvency, but whether all these companies have any assets or not, and obviously because one has the land, one is selling the inventory. So this is a very good fit case for insolvency if the lenders are also same. Because you are saying all of them defaulted. What is the GI law in international IBC? So, sir, US bankruptcy is what you read, and that is the most elaborate. And US bankruptcy only Videocon case followed. Common control, common director, common liability, common financial guarantor, interlacing of finances. So all those 14 parameters is in fact from US bankruptcy law only. G had written Era Infra, Era Landmark, Edel Landmark also had many subsidiary went into consolidated CRP. Correct, sir. Mr. Anil has written, without legal framework, the process would be subject to discretion, litigation decided by adjudicating authority. Correct, sir. That's right. We need more certainty, definitely. But till the time that comes, courts have to fill in the gaps. Any other questions? So, Manojji, timelines to follow after group insolvency. So, when such a case is agreed to by all the concerned people, they approach NCLT. The NCLT allots one common ICD. They say now ICD is this date. So, you finish off within these many days. That clock then starts ticking. You can say that. So in some cases, I have seen that NCLT says within 60 days you finish off the group CRP. If that is the case, you don't have that much time to do PUFE, right? But this fact then has to be brought into the NCLT's knowledge that in some company PUFE is done, some company it is not done. And maybe then NCLT will consider that and allow you to file it. If NCLT says ICD is now this date and you get the timeline as per section 12, then you have to just follow the timeline, whatever time is there normally in the section 12, 135 days, 115 days, 135 days for PUFE, that gets ticked off. How is the fee decided? That depends on the COC members, sir. Among them, they will decide on what the RP's fee is. Any other questions? Any more questions from participants? So, sir, Manojji, if NCLT says all these entities are now consolidated for CRP and the new insolvency commencement date is today, and you have to finish as per timelines given in the code, that means you get fresh 180 days, right? Then you follow the timelines which are in the code. Like for PUFE, it's 115, 135 days for determining, preferring an application. If NCLT says that now today I'm consolidating and within 60 days you finish off the process, then maybe it's assuming that all other compliances are already completed. And if it's not completed, it is on us to tell NCLT that I still have to do this, that other entity might have done it, I have not done it, so give me additional time. So that fact has been made clear, and NCLT in its order will give the timeline then, since there is no legal framework right now. They'll look back period 2 years. So if NCLT gives a fresh timeline, then of course look back period will be 2 years before that fresh ICD. There is lesser number of GI, so questions are only few. That's true, sir, very true. But you will always see some kind of related party structure going on in your own cases, which can come up as an issue tomorrow. They'll be dependent on your entity is in CRP, you are not paying them, they are not supplying you, right? So they can also get triggered into insolvency. Any other questions? You have my number. I'm on LinkedIn. You can contact me on mobile or LinkedIn or Gmail, whatever feels comfortable. GI cases will be allotted to IP acting as IP. IP can also act as IP. IPs are anyways acting as IP, so it can be allotted to anybody, sir. I see only 2 or 3 participants asking. More interaction would be nicer for you as well, me as well, because then we learn from each other.
Thank you, Mr. Badri Narayanan. It was a lovely session. You have quoted good number of cases.
Thank you.
I think you have covered all the group insolvency major cases, all from Videocon to.
Tried my best, sir.
I think you covered in detail. Yeah. So it has refreshed our knowledge about that.
It will be helpful, I'm very sure, sir.
Yeah. It has reminded us. Because I went to SBI for Videocon presentation. I also called one of the, they had invited, SBI was the main lead bank.
Okay. Someone else has...
Badri Narayanji.
Yes, sir. Yes.
My query is still left. I have a case where the PUFA transactions in the look back period are existing and it has been reported in the PUFA transaction report.
Right.
Now with a fresh ICD, the sum of the transactions are now becoming excluded from the 2-year look back period. And the corporate debtor is now saying that they are excluded and he is contesting it. In such a case, what should be done
ICD,
as a forensic auditor?
How is it a fresh ICD? Can you just elaborate?
after a group consolidation, as you said, a fresh ICD is there.
So
So
in your
2
case,
years
there is
from
a
there,
consolidation.
yes, there is a group consolidation, and the ICD from the date of the old ICD, there is a substantial time gap for the group ICD date.
Okay.
So 2 years
Okay.
look back period has shifted to a large extent between the original ICD.
I understood the point. So, but the transactions are
In
not under
such case,
66 or 49, right?
under 66 it is okay, but what a CD is saying that already the original ICD has taken place, so he is not responsible for any transactions between the original ICD and the group ICD. So
But
66 is
in
out.
original ICD and
And
group ICD, you are under CRP. How does the suspended management come into the play? The RP is their handling, right?
Correct. But the implications of the earlier transactions are appearing in between these two periods. That is where the issue lies. Also, preferential transactions which are originally within the 2-year look back period of the original ICD are now becoming excluded because of the group ICD being,
No,
shifted
logically
forward.
that will not be fair, sir. I think whatever
I
observation was
understand that.
made from your original ICD, that will still prevail. And from original ICD to group ICD, is the RP's moratorium is there, right? Whatever
Correct.
implications are flowing because of your previous preferential transaction, which was reflected from your original ICD, the implications also are captured in that. So once you are saying that I will look at the period from original ICD preceding 2 years, you can take that stand, and even coach will be in line with you only on that stand.
Precisely. So I
If the
just wanted to
66
have
and
clarity on
49, you
that.
don't
Thank
have a
you.
problem because there's no clawback period. 49 or 66, you will not
Yes.
have a problem anyways. Yeah.
Yes. I just wanted to have clarity on that. So the
Sure.
original ICD for the PUFL
Of course.
look back period will remain.
So
Yes,
you can
thank you so
always say
much.
that the group insolvency is only to make it more effective and resolve it
Process.
quicker.
Yeah.
It's a procedural coordination, not to leave
Yes.
off some avoidance.
Absolutely. Yes. That is what my stand is. Yeah.
Sure.
Thank you.
Anybody else?
Thank you so much.
Thank you, sir. Any other queries from anyone else? If not, then we can close the session. You can always reach out to me on mobile or WhatsApp. Right. Thank you so much. Thank you so much, everyone.
Thank you so much.
Thank you. Thank you so much. Take care. Have a great day. Bye.
Yeah, you too.
Thank you.
Thank you so much, sir. The session was very wonderful and informative.
Thank you, ma'am. Thank you. Bye.